Hi everyone, happy Friday! It is Friday, I'm so excited. The bell just rang, the market is closed. Now is when we get real work done. I hope everybody had a great week. I am so super pumped because this is our first one. And normally every week I will either do an investment, like either a tip or just talk about an investment, something that's worked for somebody, or just for general information, just so you know what's out there for you, so you know better what to choose for yourself. And if you have questions on it, then we can talk about it. Or I will just give a general financial tip, to help you build wealth, to help you just better your financial situation. So that's my goal, is to just field questions and get you the information that you need to make good decisions, and to, of course, not get taken advantage of is also a huge goal of mine, because there's so much misinformation out there, and it's always good for you to have that information at your fingertips. So weekly at 4 o'clock we'll do this. Today it came up in one of my discussions with my clients, so I thought this would be an awesome conversation for our first Friday. If any of you are familiar with investments, typically, I like to talk in basic language, so don't get bored, because I'll get there. I just have to lay the foundation, just so everybody is on the same page and you know what I'm talking about, and then I get to the actual, discussion. So an exchange traded fund, or an ETF, is just a long name for an index of something. So people might be more familiar with like a mutual fund. So instead of just buying one stock, instead of just buying Apple, you might buy the technology fund, and it has a bunch of technology positions in it. So it might have IBM and Microsoft, so you're buying an index. So the idea is diversification. So you might be buying 100 positions, and I say positions because it's not always stock. Sometimes it's bonds, sometimes it's commodities like gold and silver. So whatever it is, the point is you're buying multiple of something within one position. So when you buy an ETF, if you bought it in your E-Trade account or Ameritrade or whatever, you would see one position, but within that one position, you've got maybe 100 stock, for example, just like the example I just gave. So the conversation came up in buying ETFs, so double and triple levered ETFs, which means you can buy an ETF that moves double the index. So if the S&P, for instance, moves 5% over, a month, you'd go up 10%. In theory, I'll get to why that's not exactly true in a second. It's not an exact science, but that's the idea. Or let's go break it down by day. So if the S&P moves 1% in a day and you bought the double S&P bull means positive. So if the S&P went up 1%, you'd go up 2%. And vice versa, the bear is, if the S&P went up 1%, you'd go down 2%. So the bear is the opposite. And then there's triple out there as well. And this isn't just for the S&P. There's financials, there's a bunch of sectors, there's gold, there's the double gold, bull and bear. So there's a whole bunch out there. And so this conversation came up because we were talking to somebody that has a lot of money. And he's like, I'm having so much luck in these double and triple ETFs. I make a ton of money, and which is great. I'm super happy for him. But I just wanted everybody to be aware of them, because they are out there. And it is kind of crazy to think that I buy something that if the S&P moves 1%, I make 2. That's kind of crazy. And it's so simple, really, kind of dangerous, because you could just go out there and buy this ETF and not even know what you're buying, and it really moves. I mean, think of the volatility of these ETFs. Triple the movement, I mean, it's kind of crazy, especially since, like, if you buy the double financial bear, for instance, there's been days where financials go down 3%, so then in a day, if you're the double financial bear and the financials go down 3% in a day, you just made 6%. Like, it's kind of crazy. So anyway, so he is having success with this, but there's several things that you should know. First of all, there's no, on the exchange, there's no actual investment way to invest in these things. So what they do is they buy the futures, and it doesn't really matter what that means specifically. What it means to you is that there's there's erosion of price. The price will go down purely because of time, because they're buying futures, and futures go off of time. So you're buying a 1 month future, for instance. So the closer you get to that end of that 1 month, the price of the ETF would go down. So what does this mean to you? This means that if nothing happened, let's pretend you bought a double S&P bull. So you want the S&P to do well, and the S&P did nothing for a week. Let's just pretend, because that obviously never happens. Let's just say that. The price of your ETF, though, would still go down a little bit just because a week has gone by. So that's what I'm trying to tell you, is that it's not purely double what the ETF, double what the S&P does, or double what gold does, or whatever you're invested in. There's time value erosion in the price. So I'll give you an example, the VIX. The VIX is the measure of volatility in the market, and volatility is how much the market goes up and down. When the market doesn't really move much, there's not much volatility. And the market is really going crazy, there's a lot of volatility. So there's this index called the VIX, which measures volatility. And there's an ETF for that VIX, VXX, and it measures the VIX. I hope you're following this. And the reason why this is important is because they just did a 4-for-1 or a 1-for-4 split. Now I can't recall, but it was just 2 days ago. So what they did was the price went all the way down to like $9 or $10, and they did a reverse split, and now it's back up to 47. So it can be misleading, because all of a sudden you go in one day and it's $9, and you go in today and it's 47. You're like, what happened? So because the erosion of time, they have to adjust these prices every so often to kind of kick it back up again. So you have to be aware of these things, that these are not a quote-unquote long-term investment. These are a trade. So these are something that you're really looking for, something quick. You really understand, maybe you have a different way that you analyze the market. Maybe you have a good hunch based on some good data that you do. And we can get into research techniques in this Finance Friday session as well. But if you believe that the market is really high and you just feel like volatility has been so low, the market closed flat pretty much again today. Volatility has been so low. So I hear almost every day, the market's so high, the market's so high. Well, if you want to increase volatility in your life, you can go to these double and triple levered ETFs. I mean, they will spice up your investment world real quick, because they're kind of risky, right? I mean, they move super fast. And then on top of it, there's options on the double and triple levered ETFs. We don't need to get into that. That's really risky. But my point is, you can make a quick buck in something like these, but you got to know that it's not a long-term investment. It's something that you're just making a quick trade, and you're in and out. Like when I say quick trade, I mean sometimes it's even by the day or by the week, because you've got this time value erosion in the price. And it's definitely something attractive to investors that don't really know what stock to choose. When you're like, how do I analyze stock and how do I pick stock? Maybe you just have more of a hunch on gold. Or maybe you just know that you think financials have been really low, or technology has been really low, and you want to buy in. So instead of trying to individually select stock, sometimes you're just going on a hunch on a sector or on an overall market. And if you think the market is really, really high right now, you could do your research and say, I want to buy a double or triple ETF on the market because I think it's got to go down eventually. You just got to watch that, because you don't want to sit in that for the next 6 months. Volatility has been low for a while, and you just want to make sure that you're in and out of that trade. If you're wrong, you're wrong. Don't just sit in it, because you'll just lose and bleed money because of the time value in those double and triple ETFs. Hi, Lisa. And so now that we've talked about these ETFs, I'm going to do a quick recap. So again, double and triple ETFs are something that move double or triple whatever you're trying to invest in. So the example I gave, Lisa, I know you just joined, is like gold. So if gold goes up 1% in a day and you're in the double gold bull ETF, then you would actually make 2% in that day. So again, these are something that are a trade. They're super attractive if you don't want to be a stock picker and you just have a hunch on an index. And I guess I'll leave it at that. I hope that gave a good explanation of, just giving some information on these types of things. There's, of course, risk in it, I mean, you're not investing in any one company. So there's not a ton of research that you can do on like the ETF itself. Again, you're just kind of going on a hunch on the trend of a sector or the trend of an index. Now, that leads me to, that's my investment of the week. So every week I'm going to go over an investment like that, and I'll go into detail, and I'm sure I'll get texts and emails of things that I should be covering to give more information on, or even a strategy. But this week, since it's our first one, I'm going to do both an investment and a financial tip. So we have these Nova Wealth Management commandments, the Nova commandments. And today, for my financial tip, I wanted to cover, hey Frank, I wanted to cover, you guys should call Frank, by the way. I wanted to cover the first commandment that we have, which is hire an advisor that's not afraid to say no. So a lot of people that we run into have advisors that just kind of agree with them, or just kind of say, you know, yeah, they never have an opinion really. They just kind of say, yeah, just write it out, you know, it'll be fine. Or you're diversified, we built your strategy for the long term, everything's fine. You know, and I really think it's important that when you have an advisor, you don't hire somebody that just goes along with what you're thinking. If you're looking for somebody just to give you confirmation, that's where you talk to your buddies at like the poker table, or, you know, just at the bar or whatever. You know, you're looking for confirmation. But if you're truly looking for an opinion based on your finances, based on your goals, what you're trying to accomplish, where you're trying to get in life, don't hire an advisor that just is a yes man. You know, I'm not afraid to tell you no. So unfortunately, if you call me and you say, you know, I want to buy this car because, and you're going to have every good reason in the world to justify it. But if in your plan it doesn't make sense, then I'm going to give you that data, and I'm going to show you why that doesn't make sense. So not only do I just say no, you need an advisor that backs it up. So it's very important that, and I don't mean just financial advisor. I mean, when I'm talking about advisor, I'm talking about tax advisor, insurance advisor, you know, talk to your property casualty agent, banker, mortgage. I'm talking about any of your professional advisors. You really need one that gives guidance, not just agrees. You know, you don't want a yes man, because that's what you're A, paying for, and B, that's an easy way to kind of get taken advantage of. You know, you pay these fees and you pay for specific advice, and you kind of get in your own way. That's why you pay these people. So you want to make sure that when you hire somebody, they don't just agree. It's kind of tough when I say hire somebody that's not afraid to say no, but I really mean hire somebody that's not afraid to give you their opinion. Hi, Erica. Hi, thanks for joining. And hire somebody that is not afraid to give you your opinion. Erica's one of them. She's not afraid to give you your opinion. Hi, John. And so I think that's a super important thing to get your money's worth, is to hire professionals. Again, not just financial advisor in my industry. Any advisor that you have that gives you advice, make sure that you document their opinions. You know, make sure you're getting true advice, and go back to what they say and say, when I asked that question, did they just say language like, oh yeah, you know, that sounds good, or if that's what you want, or, you know, in my industry, a lot of times it's if that's what makes you sleep at night, you know. And I do say that to clients. I'll say, look, I can't pretend like something doesn't make you sleep at night, but here's the facts. Okay, so let's make a decision based on the facts, and then let's talk about your emotion. Now, do you want me to help you manage your emotion? Do you want me to help you get out of your own way? Or would you like me to take a step back right now? Because all I'm going to do is give you the facts. And maybe I'm not the right advisor for you if, you know, we consistently do this. If this is a consistent behavior where you constantly go with the emotion instead of the facts, then maybe it's just not the best relationship. Maybe it's just not the best fit. So find advisors that align with what you are trying to accomplish. And I think you will find time after time after time that you make better decisions, and you stop looking back and be like, oh, this one time I got this advice, you know, and look back on that conversation and say, yes, this will empower you to make your own decisions. It will give you the data to make your own decisions. When you ask for that proof, you know, when you ask for, you know, why should I switch from this insurance to this insurance? You know, what is the data on that? Show me what that means to me. Not just what that means in the actual switch of the policy. What does that mean to me? How does that change my situation? Ask these types of questions. What does it mean to me? Why are you telling me yes or no? Not just, yeah, that sounds great. Yeah, I'm okay with that. You know, don't just hire a yes man. And I think you will find that you will be much better off. So again, for those that just were tuning in, the investment we talked about today were double and triple ETFs. So go back and watch that if you at all want to find out about those. Again, not recommendations, just general information. I'm just trying to get information out there for people that want to know about them and want to understand them, because they're actually fairly new. I don't want to say new, but like in comparison to mutual funds, they're fairly new. So you also want to watch out for the liquidity in those, and how you, if you do big trades, and if you can get out of them. And that was the other thing I wanted to mention on those double and triple ETFs, is the liquidity of those. So we talked about the double and triple ETFs and where to find them. Obviously, with the internet nowadays, Direxion is a big company that does them. One's not necessarily better over the other. I'm just trying to give you the information. And then we talked about Nova's first commandment, which is hire an advisor that's not afraid to say no. And this is all advisors. Make sure you're getting your advice worth what you're paying for. So I hope this was an awesome live. I hope you got something out of this. Shoot me emails, shoot me questions, go to our website to contact us. And if you have other questions, and for next week, I'll be doing an investment next week as well. And if you have any specific investments that you want me to talk about, go ahead and contact me, and I'm happy to do that. Thank you so much for joining, and everybody have an awesome weekend. Thanks.